What if the safe corner of your portfolio, the high-interest savings account you chose to protect your nest egg, was actually setting a trap for your retirement? On the surface, earning 4, 5, even 6% without lifting a finger sounds like a dream come true after decades of market volatility and stock-picking headaches. But beneath those tempting APYs lie hidden risks that can quietly erode your financial cushion faster than you realize. Imagine waking up one morning to discover that your income stream has been slashed because the bank cut rates overnight, leaving you scrambling to fill a sudden shortfall. Picture your nest egg losing real value as inflation continues to climb beyond your yield, and then feeling the sting again when Uncle Sam takes his full share of every dollar you earned in interest. Consider the complexity of spreading your money across multiple banks just to keep it all FDIC-insured, juggling passwords and minimum balance requirements, only to find yourself facing surprise fees or withdrawal restrictions at the worst possible moment. And while you're clinging to that cash safety net, you could be missing out on opportunities for growth elsewhere, locking in security today, but forfeiting the chance to keep pace with rising costs over the long term. In this video, we're peeling back the curtain on 5 of the most overlooked dangers lurking in high-interest savings accounts for retirees, each one powerful enough to transform a seemingly risk-free haven into a source of financial stress. If you think you've found the perfect solution for your cash cushion, think again. Stay tuned, because the next few minutes might just change the way you think about protecting your retirement funds forever. Interest rates are like a double-edged sword. Banks can hike them in a heartbeat when they want to track deposits, but they can slash them just as quickly when their funding costs rise, leaving retirees stuck with a suddenly diminished income stream. You might have kicked off retirement celebrating a new era of guaranteed 5% yields on your cash, but what feels solid today can evaporate tomorrow. Unlike a fixed annuity or a bond ladder with predetermined payouts, a high-interest savings account gives you no promise beyond the current headline APY. One board meeting, one shift in economic forecasts, and that juicy rate you're banking on disappears, forcing you back to square one, hunting for the next big yield while living off a smaller paycheck than you budgeted for. And it isn't a one-time sting either. This rate volatility can erode your confidence and cash flow year after year. Imagine building your entire withdrawal plan around a comfortable interest check, only to wake up one month to a rate cut that turns your annual income projection into a math problem you didn't sign up for. Suddenly, your carefully balanced budget has a gaping hole, and you're scrambling to make up the difference. Perhaps dipping into principal earlier than planned or cutting essential expenses just to cover routine bills. That uncertainty can be stress-inducing, especially when every dollar counts in retirement. You traded market risk for rate risk, and it's a gamble that rarely gets the attention it deserves. But that isn't the whole story. Because even if you navigate the roller coaster of rates, there's another force quietly working against you. Even a seemingly strong 5% APY can feel like a gift until you realize inflation is quietly sprinting ahead, shredding your purchasing power dollar by dollar. While you're celebrating a higher rate, the cost of groceries, utilities, and medical bills may have jumped 7% or more, meaning each interest check buys less than it did last year. Inflation isn't a one-time hit, it compounds. At just 4% a year, prices nearly double in 18 years. Your secure cash cushion then starts behaving more like quicksand, dragging down the real value of everything you thought you held safely in place. And because high-interest accounts typically hold only cash, they lack the growth engines, like dividend-paying stocks or inflation-protected bonds, that can help offset rising prices over time. What's worse, many retirees mistakenly believe that by keeping most of their assets in cash, they're avoiding risk. In reality, they're exposed to an invisible erosion that doesn't show up on account statements until it's too late. You might not notice your balance dropping, but the things you can buy with it shrink month after month. Before long, you find yourself choosing between cutting weekly grocery trips or tapping into your principal to make ends meet, precisely the scenario you wanted to avoid by chasing higher savings rates. And when that gap opens, you could end up turning to your children for help paying routine bills. simply because no interest rate, however attractive, can outpace runaway costs forever. But even overcoming rising prices won't protect you from the next hidden pitfall. Interest income from your high-yield savings account might seem like entirely free money, but every dollar you earn there is treated as ordinary income by the IRS, with no preferential rates, no deductions, and no loopholes. That means if your account delivers, say, $10,000 in interest over the year, you must report that full amount on your tax return, taxed at whatever bracket you fall into. For someone already living on fixed retirement income, an extra few thousand in interest can be enough to nudge you into a higher tax bracket, increasing the rate you pay not only on that interest, but on every other dollar you earn. And because interest is taxed as ordinary income, it also counts toward the adjusted gross income figure the IRS uses to calculate Medicare premium surcharges and the taxable portion of your Social Security benefits. In other words, there's a cascading penalty. You earn more in interest, you owe more in taxes, and then you may pay hundreds more in Medicare Part B and D premiums and face a bigger bite taken out of your Social Security checks. This hidden tax drag rarely shows up in the glossy rate advertisements for high-interest accounts, yet it can erode your net gains far faster than falling yields or inflation alone. Worse, if you hold these savings in a taxable account rather than a tax-advantaged vehicle, you miss out on opportunities to shelter that income. Municipal bonds, Treasury inflation-protected securities, or even Roth IRAs might offer lower headline yields, but when you factor in taxes, they can deliver better after-tax returns. Many retirees discover this too late, realizing only after filing their returns that the promised safe income ended up costing them thousands in extra liabilities and potentially blowing holes in their carefully constructed budgets. And even if you're comfortable paying that tax today, every future rate hike, account balance increase, or compounding interest payment carries the same unforeseen cost, quietly eroding your principal as you pull money aside to cover unexpected charges. But while taxes loom large, there's another set of rules you may be overlooking, rules that govern how much of your account is truly protected if the bank itself runs into trouble. When you chase that top-tier 5% APY, you're often forced to scatter your cash across multiple banks just to keep each chunk under the $250,000 FDIC insurance cap, because anything above that is exposed if your bank fails. That might mean juggling a dozen online accounts, memorizing endless logins, and racing to move funds if one institution shows signs of trouble. It's a logistical headache that no one warns you about until you find yourself locked out, calling customer service while your most secure money sits vulnerable. Even worse, smaller banks or credit unions offering the highest rates often carry higher risk. They may need those deposits to fund loans or operations, and if defaults rise, or if a sudden liquidity crunch hits, they could be the first in line for a bailout or worse, collapse. Meanwhile, you're left wondering where your six-figure balance went. And if you do manage to spread your funds wisely, you face another burden. Keeping track of different statements, varying interest payment dates, and changing terms and conditions that could slash your yield without warning. It's enough to make anyone wish they'd stuck with a simple, single institution, even if the rate was a percentage point lower. But in retirement, complexity isn't just inconvenient, it can freeze you in place. You may hesitate to move excess funds when a better opportunity appears, worried you'll miss a deadline or forget an account altogether. And that indecision can cost you more than any fee ever could. These FDIC limits and bank stability risks aren't headline news. Yet they're exactly the kind of hidden friction that can eat away at your portfolio, leaving you scrambling for cash or turning to your children sooner than you ever imagined. Up next, we'll uncover another covert threat hiding behind those glossy rate advertisements. One that strikes when you least expect it. Some high-yield accounts lure you in with impressive APYs, but lurking beneath the surface are fee schedules and withdrawal rules designed to protect the bank more than your balance. You might open an account promising 5%, only to find out you must maintain a $50,000 minimum or face a $15 monthly fee that chips away at your returns. Drop below the threshold even briefly, say, to cover unexpected home repairs, and you're premium rate could collapse to a fraction of what you signed up for. Worse yet, some accounts tack on transfer limits or require several days' notice before you can withdraw funds, meaning you can't tap your cash when you truly need it. Missed notices can trigger penalties, and overnight transfers don't always arrive in time. Imagine needing $5,000 for emergency dental work, only to discover you have to call ahead, fill out paperwork, or endure a week's delay before that money is available. Time you simply don't have. And every day your capital sits idle counting down notice periods, you're losing potential interest or facing late fees on bills you couldn't pay. The fine print also hides inactivity fees, unexpected closure penalties, and tiered interest rates that drop based on total balance or deposit volume. Account comparisons become a minefield of asterisks, footnotes, and confusing marketing terms, making it all but impossible for retirees on fixed incomes to know exactly what they'll earn or pay in any given month. This level of complexity defeats the very purpose of a safe savings vehicle, turning what should be reliable interest income into a game of gotchas, one that can decimate your nest egg and leave you leaning on your family for cash when you least expect it. And these hidden traps aren't obvious until they spring shut, pulling precious dollars out of your retirement plan without warning. By pouring too much of your nest egg into high-interest savings, you may feel secure. But that security comes at a cost, and often it's one you don't see until it's too late. Every dollar parked in a savings account isn't invested in assets that have the potential to outpace inflation or deliver higher long-term returns, like dividend stocks, real estate, or Treasury inflation-protected securities. This is the opportunity cost of oversafety, sacrificing growth potential for the fleeting comfort of a guaranteed, yet variable yield. Over decades, that trade-off can translate into hundreds of thousands of dollars in foregone gains. Gains that might have provided your portfolio with a buffer against future medical bills, market swings, or unexpected tax hits. Worse, when retirees stick too rigidly to cash-heavy allocations, they often lack the flexibility to rebalance into risk assets after downturns or to generate sufficient growth in the first place. This conservative posture can lock in underperformance, leaving savings more vulnerable to sequence of returns risk and weakening your ability to support yourself throughout a potentially 30-year retirement. And when retirement budgets come up short because inflation, fees, or rate cuts have eaten away at your interest income, the natural response is to withdraw more principal, further depleting the assets that could have driven growth. That cycle accelerates depletion, moving up the point when you'll have to turn to your children for help. Balancing security with the need for growth isn't just prudent, it's essential. A diversified strategy that blends liquidity with inflation protection and growth assets can help ensure that your money works as hard as you did, so you maintain independence rather than feeling forced to rely on family support when those unanticipated shortfalls hit. Retirees often think they've found the perfect refuge in high-interest savings accounts, a place where their money sits safely and works silently for them. But as you've seen, that apparent safety comes with hidden strings attached. Rate cuts can strike without warning, transforming a steady income stream into a scramble for replacements. Inflation can outpace even the most generous APYs, quietly eroding your purchasing power until your nest egg buys far less than you bargained for. The tax man stands ready to snatch every penny of interest at your highest bracket, then ding you again with higher Medicare premiums and Social Security taxation. Your cash may be safe, but only up to a point. Spread across multiple banks to dodge FDIC limits, struggling under complex fee schedules, minimum balances, and withdrawal constraints that turn easy access into a bureaucratic headache. And all the while, that money isn't growing. It's sitting idle, missing out on the very returns that could help you stay ahead of rising costs and unexpected expenses. Security means more than just principal protection. It means combining predictable income with growth potential, flexibility, and genuine peace of mind. True retirement resilience comes from a diversified approach, one that weaves together liquid savings, inflation-protected instruments, and strategic equity or real asset exposure. By understanding these 6 hidden pitfalls, you can choose the right balance of safety and opportunity, ensuring your cash works as hard as you did. Because at the end of the day, the goal isn't just to keep your savings intact, it's to make them last as long as you do, without ever having to lean on your children for support.